Good morning, everyone. Welcome to the Commodities and Currencies Daily Podcast. We will be seeing what are the major triggers that drove the prices for last week. And for this week, we will be looking ahead for what are the main levels as well as the key triggers for this week. So let's start. Starting with the precious metals, what we saw in bullions was a very positive week as the silver prices especially rose from $50 an ounce to more than $57 per troy ounce in early trade today, where the rise in prices of silver were also eclipsed that of gold as the gold silver ratio falling to an annual low of just over 77. Spot silver settled at around $56.39, up 12.4% for the week. It smashed its previous record of $54.49 set in the mid-October, uh, primarily because the bullion's prices were being buoyed by expectations of an interest rate cut by the US Federal Reserve in the week ahead. In addition, silver prices also saw a surge because of the inventories registered on the Shanghai Futures Exchange, falling to their lowest levels in the 10 years, as those on the Shanghai Gold Exchange have also fallen to their lowest level in more than 9 years. This was triggered by China's record exports of 660 tons witnessed in the month of October. That apparently went to London, where shortages had occurred in October. The silver ETF markets, tracked by the Bloomberg, recorded an inflow of almost 290 tons in the recent days, which withdrew supply from the market and is also likely to have contributed to the price increase. Overall, expectations remain that due to the rate cut expectations in the upcoming US Fed meeting, which has risen to around 90%, up sharply from the week before, because of the Federal Reserve officials, including Christopher Waller and John Williams, have reinforced their dovish narratives. Also, the main trend for silver prices remains up, especially through though volatility and profit booking moves may also be seen during the week because of the sharp bullish rise have been seen in the last week. A weaker dollar could also give an extra push to the to the precious metals, while the dollar has settled at around 99.479 on Friday, which is down 0.72% on the week. On the MCX, silver levels is expected to trade with supports at around 1,72,300 as an immediate support, followed by 1,69,600. On the higher side, we see resistance for the prices at around 1,76,200, followed by 1,78,900. Overall, the positive bias is expected to be maintained for silver for this month. Now, talking about the base metals, London copper hit a fresh record high at 11,210 to $11,294 per ton levels on the LME, where it was driven by an intense global supply squeeze. The Shanghai Industry Meet underscored how the tight market has become, with the miners have also pushed the smelters to accept record low TCRCs, while the premiums for refined copper into China had jumped to all-time highs. Unplanned mine disruptions through the year, plus aggressive US buying ahead of potential Trump era have import tariffs have deepened the supply imbalance. Major traders like Mercuria have warned of structural shortages ahead, which has added to fuel to the market already up 30% year to date on strong electrification demand. The outlook for the this week, the momentum remains bullish, with the market likely to test higher levels as copper supply remains very tight, so extra charges like premiums and spreads are staying high. The US is pulling in more copper ahead of possible tariffs in 2026, which means that less metal is available for Asia. Miners and smelters are still struggling to agree on ore prices, showing that raw material supply is still limited. Bias remains positive to firm, where sharp rallies may face bout of profit booking also, given the record high levels, but supports to persist around 11,000 and $10,950 per ton levels on the LME. For MCX December contract, the levels for copper is the supports are expected at 1036 and 1026 levels. And for the higher side, the resistance is expected at 1041 to 1050 levels for the coming days. Now, talking about the energy complex. Crude oil traded mixed throughout the week, where WTI ended at around $58.55 per barrel levels, marginally higher as hopes of a Russia-Ukraine peace deal and stalled negotiations initially pressured the prices. However, the stalled negotiations and the basically the the stalled peace negotiations have helped the market to stabilize in the later half of the last week. Still, crude ended its fourth straight month of decline, where its longest losing streak since 2023 has continued, and it's down 15% year to date as record US supply and rising inventories have exerted pressure on the prices. Crude oil outlook could remain with a that current week could begin with a firmer tone as OPEC Plus reaffirmed that its pause on output hikes through Q1 it could be maintained with 3.24 million barrels per day of voluntary cuts expected, while fresh supply risk from US Venezuela tensions and disruptions to Russia Kazakhstan CPC pipeline have added a supportive geopolitical premium. WTI bounce towards $59 plus could suggest some short-term stability, but the broader trend remains range-bound with a mild bearish bias for the week. Given the record US supply and the softening demand signals, WTI supports could be around $58 and $55.90, and resistance on the higher side could remain at around $60.5 and $62. For currency, the market participants are expecting that the US-India trade deal could still remain stuck and could weigh on the sentiments for the rupee for the short to medium term perspective, while domestic uncertainty could also amplify the rupee's troubles. However, the stronger GDP print released last week is seen to support the sentiments in the near term, where rupee could be expected to trade with a slightly positive bias on rising odds of a rate cut by the Fed in December and also due to the easing geopolitical tensions. USD INR is expected to trade in the range of 89.10 to 89.70 in the near term, given the mix of the triggers. Now, talking about the key macroeconomic data that is scheduled in the week of 1st to 5th December, we will have the major labor data to be announced this week, where the JOLS job openings could be released on the 2nd of December, and the ADP non-farm employment change data could be released on the 3rd of December. We will also see the initial jobless claims coming out on the 4th of December, where we have the RBI policy scheduled on the 5th of December, and we have the US personal spending and PC index data coming out on the 5th of this month. So overall, this is all about the updates, and I hope you will have a successful trading day ahead. Thank you very much.